We tend to think of global wealth as solid ground, but the foundations under the world's most lucrative cities are shifting under trillions of debt. Extreme private wealth doesn't distribute evenly across the map. It pools in specific geographic hubs, creating massive centers of gravity for capital. New York is the primary example. The city alone has birthed 69 billionaires, more than any other city on Earth and more than the next 5 major U.S. cities combined. This concentration repeats across Asia. Hong Kong has produced 57 billionaires, Singapore 30, and Mumbai 28. These megacities function as the world's most efficient engines for private capital. But operating inside these engines now comes with a significant contradiction. The same cities generating the most private wealth are also carrying the heaviest public debt burdens. This chart tracks global government debt. In 2000, the world owed $19.7 trillion. By 2025, that figure reached $111 trillion, with a sharp acceleration starting in 2020. Two nations, the United States and China, now carry over half of that total debt. That is $57 trillion in public liabilities sitting directly beneath the world's two largest wealth engines. This creates a dilemma for anyone building a business or allocating capital. Do you pay the high entry costs of a legacy wealth hub, or do you seek out a low-cost, low-debt outlier environment? Simply following the historical birthplaces of the world's richest people ignores the macroeconomic friction those cities face today. You have to weigh the network effects against the rising cost of the ecosystem. The legacy hub strategy involves locating yourself or your capital in top-tier global cities like New York, San Francisco, or Hong Kong. The advantage is proximity. You get direct access to established capital allocators, deep talent pools, and infrastructure designed to scale businesses quickly. Larry Ellison is a product of this environment. Born in New York, he utilized that ecosystem to build Oracle, reaching a net worth near $200 billion. Taipei is another high-ranking hub. It birthed Jensen Huang, who founded NVIDIA and currently leads the world's most valuable company by market capitalization. The trade-off is the rate of capital consumption. High living costs and heavy overhead mean founders in these hubs burn through their operational runway much faster than their peers elsewhere. There is also a tax implication. Large public debts often force local and federal governments to increase future taxes, which directly compresses private sector profit margins. Operating in a legacy hub is a high-leverage bet. Success requires scaling revenue fast enough to outpace the systemic costs of staying in the game. The niche outlier strategy involves building wealth away from the gravity of traditional megacities. When you adjust for population, the data shows surprising results. States like Missouri and Massachusetts dramatically overperform, producing more billionaires per million people than almost any other state. It also shows that massive scale can happen anywhere. The richest individual born in the U.S., Google co-founder Larry Page, was born in Lansing, Michigan. Globally, the ultimate outlier is Ingelheim on Rhine. It's a German town of under 40,000 people, yet it has birthed 10 billionaires. This happened by anchoring a local economy to a single privately held industry, in this case pharmaceuticals. The trade-off here is a lack of organic networking. You gain a longer runway due to lower costs, but you have to work harder to find venture capital and strategic partners. This strategy trades easy network access for capital preservation. Success requires a go-to-market plan that functions independently of physical chance encounters. From a macro investor's perspective, the US and China represent a unique set of risks and rewards. These two nations generate half the world's wealth, but they also carry its largest liabilities. China's public debt has grown at 18% per year since 2000, much of it used to fund local infrastructure and property development. In the United States, federal debt jumped from $23.4 trillion to $28.3 trillion in a single year, and has since climbed to $38.3 trillion. With interest rates elevated, the cost of simply servicing this debt is rising sharply. This creates long-term fiscal pressure that can lead to increased regulatory friction. In contrast, markets like Japan or certain EU states have stabilized their debt levels since 2012, potentially offering more predictable environments for long-term capital. Investors must determine if the GDP momentum of the US and China will remain strong enough to outpace the drag of their growing debt burdens. Megacities offer the highest volume of opportunity, but outliers offer the highest capital efficiency. This matrix maps that decision, plotting your tolerance for overhead on the x-axis against your need for physical networking on the y-axis. A founder seeking rapid institutional scaling belongs in the top right quadrant, the Legacy Hub Premium. If your business model relies on rapid growth and constant access to investors, the network density of New York or San Francisco is likely worth the high debt and high cost trade-off. A bootstrapped entrepreneur belongs in the bottom left quadrant, the outlier strategy. Building in states with high per capita wealth but lower costs preserves your runway. You can use digital tools to leverage a global market without the crushing overhead of a legacy city. For a macro investor, the priority is pricing in the current $111 trillion global debt reality. Historical wealth hubs are not inherently safe harbors. Future returns will depend on how these regions manage their fiscal liabilities. Generational wealth now depends on aligning geographic location with a business model's specific capital and network requirements.